Live with another Taxes and Bourbon. So thank you all for joining us today or rewatching this video if you're rewatching the video. No major updates on tax legislation. So we'll just start off there. No movement. Although there's supposed to be some movement this week. I'm actually holding off. I've got one more video to record for the Tax Smart Boot Camp that I'm running. We're on week 4 out of 4 this week. And there's one more video, and the one video was on the Biden tax plan, and I've been holding off recording that one video, even though we're almost done, because I want to see what the Biden tax plan is actually going to be. But right now, there's no movement on it. So there's also talk that it could just be pushed to 2022, which would probably mean that it doesn't actually happen at all, which would be interesting. But some would consider that a win.
Yeah.
Yeah. I would consider that a win. You know what? They always implement this stuff like a month before tax season kicks off in full swing. They always do that. Yeah. Tax Cuts and Jobs Act, the CARES Act, the 2020 stimulus stuff. That was crazy. It was all right in the middle of tax season. So you're yeah.
And it takes another 2 years for them to figure out how they want to actually do it. Like all the regulation, all the guidance and everything like that.
Right. Because if you take a position on your tax return with the current law, they might later change their mind that wasn't actually what they meant, which I think is a lot of BS.
Yeah. No take backsies, IRS.
Yeah. Well, it's all the. I don't know that I could be a politician, man. I thought about this. Like, why wouldn't super successful people like Bezos, Elon Musk, Richard Branson, et cetera, and you can say whatever you want about them, right? But why wouldn't they go be politicians? And they would. It just kind of hit me like, why would you go be a politician if you've got billions of dollars that you can deploy? Whatever your say is goes. You don't have to go and convince 1 million people to try to get stuff passed. I wouldn't be a politician either.
It's interesting, I think the smarter business leaders, they do stuff where they get themselves like a Fed chair or something like that, where it's like you don't have to be elected, you can just be nominated, and they can kind of influence a little bit of policy while they're there, and then jump back into the private sector after they've muddied the waters, to their benefit.
Good point. That's a good point. Be like a powerful voice on a committee or something. Yeah. That's a good point. Well, what are we drinking tonight, gents?
I've got this. Yeah. I got this.
Oh, you got Bullet bourbon. Nice.
Bullet. Is it Bullet or Bullet? I didn't know. Yeah, exactly how that.
It's Bullet. Yeah. I mean, I'm in North Carolina. I don't know what anybody else calls it, but it's wrong. It's definitely Bullet.
It's Bullet bourbon for sure.
Okay. Well, Tom coming in with the confirmation.
I mean, I don't know if you can hear this, but if it's got that, if it's got that when you open it up, right off the bat that it's at least a little bit more classy, right?
I'm drinking. I don't know how to say this. I'm still drinking the Michters, small batch. My brother-in-law would be ashamed if he heard me mispronounce that. I'm sure. He gifted it to me for my recent baby daughter. We had a baby daughter a month and 6 days ago. So, and that is going well. And no, I'm not getting sleep. So don't ask me if I'm getting sleep. I'm actually got to say I'm getting sleep. My wife's being a champ. She's getting up with the baby all the time. And I remember our first baby, I always felt bad, so I would get up with my wife and, like, oh, is everything okay? And all that stuff while she fed the baby.
Don't feel bad anymore, though, do you?
No. No. We worked out a system, right? It's like, look, you suffer for the first 6 months. I'll suffer for the next 6 months. That's the way that it works. Yeah, but I mean, in reality, we have a son. We have a 2-year-old son, so one of us has to be awake to keep up with him. But really, she does all of it, though. I'm not giving her enough credit. She does all of it, and she's an entrepreneur. She runs a flower pressing business, and she's like been totally booked out this year, and she's like starting to book out next year and stuff. It's really incredible how much she does with the 2 kids on top of that. Because I'm pretty zoned into this on probably 9 to 10 hours a day at least. So and weekends when Tom makes me record the podcast on the weekends.
Yeah, we got another session coming up this weekend. So.
We got another session going this weekend.
So tell your wife just to blame Tom.
Right. Yeah. Oh, I do. Yeah. She doesn't like Tom. I'm just kidding. She likes Tom. She likes him. I'm just kidding, man. I'm just kidding. I knew you take that personally. Tom's the type of guy that, like, you say a joke and it's definitely a joke, and Tom will be like, for a split second, like, oh man, are you serious? But it's okay. We love Tom. Tom, what are you drinking tonight?
I'm finishing this JMO. I have to finish this.
Nice.
And then I was gonna get the
bourbon. You keep showing up to taxes and bourbon with whiskey. This isn't.
I know. I'm breaking the rules here. Look, this is this is definitely whiskey. There's undoubtedly whiskey. There's no bourbon here. I'm almost done with this. Once I'm done, I'm gonna get some bullet bourbon.
There you go, bullet bourbon.
Yeah.
Get some Four Roses. Four Roses single barrel. That's my favorite. Actually, this is really good. The Meisters. However you say it. Yeah, I don't know how you say it. Well, tonight I want to talk about how do you, as a landlord, not pay tax. So how do rentals eliminate your tax bill? I'm not talking about how do rentals reduce your tax bill. I want to know how do you invest in rental properties and not pay income tax? You always got to pay property tax. Maybe. I mean, I guess you could always withhold. There was a Blake, our VP of operations, sent out a meme in our Slack channel yesterday, and it said something along the lines of, like, I don't pay taxes, and the IRS comes after me and tells me to pay taxes. I don't pay those, and then I go to court, and the court tells me to pay the taxes, and I don't pay those, and then they tell me I'm going to go to jail. But the jail's funded with my tax dollars, and if I don't pay taxes, there's no jail. So like, okay, I don't know that's exactly how it works, but that's funny. But anyway, I want to know how to legitimately not pay taxes when you invest in rental real estate. How do you do that?
Are you talking about, like, on your rental real estate or your overall taxes?
No, man. I want to wipe out my business income.
You want to wipe out everything.
Wipe it all out. How do I do it?
There's really only two good ways to do that, right? The first is the real estate professional status. So you have to qualify as a real estate professional. You have to work 750 hours or more in a real property trader business and more than half your total working time. And then the losses from your rental properties, assuming you materially participate in your rental activities, will be non-passive. And then you can use a cost segregation study to drive up the depreciation expense, which is a non-cash expense, on your rental property, and that will create a loss, and that loss can help you offset your tax liability, offset the income you have from your other sources, your other income sources.
You're talking like you do this all the time. All right. But I don't do this hardly ever. So can one of you explain to me what passive and non-passive losses are?
Fair enough.
Yeah, sure. I'll jump in there. So yeah, all of your income is essentially going to get dumped into one of two buckets: the passive or the non-passive income. And in general, it's what it sounds like. Non-passive income is going to be things that you're actively involved with. So if you're running a trader business, whether that's you're a sole proprietor of some kind, running like an electrical contracting business, or you're a hairstylist, something along those lines. That's going to be a non-passive source of income. W-2 is the next, the most common source of non-passive income, is you're actively working in that job. And typically, by default, rentals are considered to be passive income under the general concept that, for the most part, compared to any other types of businesses, your amount of involvement in the rental activity is relatively minimal as compared to something like a W-2 job where you spend 40 hours a week in that position.
So you're saying that the rental activities, because it's pretty minimal, those are considered passive activities, and my W-2 job or my business, I'm running the CPA firm full time, that is not passive, non-passive specifically, N-O-N, non-passive.
Exactly.
So what's the significance of that? Why does that matter?
Yeah, the significance comes into play because when you have passive losses, they are only allowed to offset others' passive income. So you can't use it to offset your non-passive sources of income, like running a CPA firm or being a hairstylist or something along those lines, unless you meet the real estate professional status that Tom was talking about.
Got it. All right, Tom, in your best British accent.
British. Jeez. I don't know. I'm going to pull this one off.
In your
Okay.
best
Come on.
In your best British accent, explain how to qualify as a real estate professional. How do you qualify as a real estate professional?
Jeez, I'm going to butcher this. All right, mate.
Take another swig of bourbon. That's why we're doing the bourbon, man. See, I've just been conning you guys for the past few weeks. Just thinking that, we're just going to sip on some bourbon and talk taxes. No, man. This is where it's really coming out. Let's go.
All right. Hold on. Let me see. British accent.
You're committed. You're locked in at this point. You got to show up.
All right, mate. I can't do a British accent. My life depends on it.
Isn't that Australian?
That's Australian. See, I mean, I would die, but Australia was just they shipped.
Justin, your best you can think about your British accent for a little bit, Tom. Justin, in your best British accent, explain real estate professional status.
Okay, let's see here.
This stuff.
Now all I can think about is Australians, stuck on my head now. Shoot, I'm trying to channel my inner Harry Potter or something here for for a British accent.
I mean, am I Australian / British? How about we just do a hybrid? Whatever you think
it'll just gravitate back
to it. Yeah.
All right. So what you need to do is you need to actively participate in a real property traded business. You see,
here we go.
And a real property traded business is going to be something that is in the fields of acquisition, construction, management, or rental activities. Something of that sort of nature. And what you need to do then is perform some of the works in these activities for at least 750 hours and more than half your time during the year. So the key thing is here, my little crumpets, is that if you're maintaining a W-2 job of some kind, it's going to be next to impossible to be able to substantiate that you're a real estate professional during the year. Because chances are you're going to spend more time in your day job than y'all going to be doing in your real estate. God's honest to the queen. That's the truth.
That was good, man. That was good, man. It got better as you went too, man. It got better and better.
I just had to feel it, get into it.
All right. So let's summarize. You got to spend 750 hours in a real property trader business and more time in a real property trader business than you do anywhere else. Look, we got there we go. Look at this. Yeah, thank you. All right, so 750 hours more time in real estate than anywhere else, and that makes your rentals non-passive, right? All right, so Tom, explain. So we just talked about the passive activity loss rules. So your rentals are passive, your W-2 income's non-passive. The significance is that your rental losses, if they're passive, they can't offset your W-2 income. But remember, I'm on a quest to figure out how to not pay taxes. I want to wipe out my income with rental losses. So I've got to so Justin just explained, you got to make these rental losses non-passive. So you got to move them out of the passive bucket, per se, and into the non-passive bucket where all my other income is. And once I do that, my rental losses I can use to offset my W-2 income and my business income, right? Right. All right. So Tom, there's another piece of this though, and this is material participation.
Yeah.
So explain how material participation works without using the term rental or rental property.
All right. So material participation is when you are playing a material role, right? Okay, so an active role in the activity in which you're trying to prove material participation. And in this case, you're trying to materially participate in a certain type of real estate activity, right? Okay. So material like Like what type of activity or type
Yeah.
of? Okay, it's an activity where you own property and you're leasing that property, typically on a year-long lease, typically maybe month to month if you're getting if you like to play it by year, to a tenant, and that tenant is going to pay you rents for as a part of that contract in that lease, right? And and in order to do that, in order to gee, this is tough. In order to do that, there's certain things that need to happen on the property, right? You need to search for the tenant, right? You need to find the tenant. You need to screen the tenant to make sure they're a good fit. Credit score checks out. They have a job. They don't have a criminal background. These are things that need to happen. Sometimes you need to get the property actually rent ready. Okay, I could say that, right? Rent ready.
I don't know. I think that's cheating.
Okay, you have to get the property to the point where a tenant actually wants to move into it at a rate that's acceptable for the market, right? Otherwise, they're not going to want to rent it out. So these activities that I'm mentioning right now are material to the business, because if the property is not in a condition where the tenant wants to lease it from you, then they're not going to want. Then you don't have then the business isn't profitable, right? Because you're going to be losing money. You're going to have a vacancy. Also, if you get a bad tenant in there, they can destroy the property. That's first and foremost. Second of all, they might not pay rent. Depending on where you live, what the landlord-tenant laws are where you live, you might not be able to evict them for some period of time. So these things are material to your business. There's also other activities that are material, such as managing the property. If the tenant complains that the light bulb goes out, hopefully the tenant will fix that themselves. But let's say there's a little bit more of a bigger issue, right? The plumbing bursts and the bathroom floods. Someone's gonna have to go fix that. If you go fix that, that's a material activity. So the bottom line I'm trying to make here, before I just meander on here, trying not to bounce around, you have to participate in this activity in a way that's going to impact the bottom line. That if you did not take these actions, that the property would either fail to run properly, or you would be putting yourself in a bad position. It'd be easier to explain it if I was able to use like.
Did I tell you not to use?
Sorry, go ahead.
Remind me real quick. Did I tell you not to use the word rental or rental activity?
Yeah.
I don't remember.
That was a good answer. I thought I was going to get him.
The material participation test, they apply to all businesses, not just rental activities. So, like a similar kind of scenario to liken it to something else would be that, if a friend of yours asks you to invest some capital to help them get their business off the ground, manufacturing widgets or something like that, or opening a restaurant or something of that sort, and all you're doing is providing capital, you're not going to be considered materially participating in that business, because you're effectively, some might refer to that as a silent partner or something like that, but you're not involved in the day-to-day operations of the business. So that's kind of the main key factor there with material participation. And there's, more specific details to get into it that are more granular as you get deeper.
So, all right. So my rentals are passive by default. My other income, my W-2, my business income, where I materially participate, that's non-passive. In order to move my rental losses into the non-passive bucket so that it can offset my income, my other income, that's the significance of this move. In order to do that, I need to qualify as a real estate professional, and I need to materially participate in the property, right? So that's how I can eliminate my income. Or that's step really one. So step two is then going and getting a cost segregation study performed.
Yep.
It's doing bonus depreciation and all of that. Can one of you guys explain how that works?
Sure. So what happens is, when you have your property, let's assume it's residential, right? It's going to be depreciated over 27.5 years. And to be specific, the building value, the improvements are going to be depreciated over 27.5 years. The land is never depreciated. So what happens is that you're going to have a depreciation expense as a result of that. That's a non-cash expense. You're not paying any cash out of your pocket today for that depreciation expense. But the question is, okay, well, how can you increase that depreciation expense? Because it's non-cash, and if you can increase it, you're going to reduce your taxable income, perhaps into a loss situation. So the way to do that is through a cost segregation study. And the way a cost segregation study works is typically an engineer is going to come to your property, and they're going to survey the property, for lack of a better term, and they're going to break down the components of that property into different class lives. Because at the end of the day, the building is not the only thing that's there, right? You have other parts. You have land improvements, which are depreciated over a 15-year period, and those include things like landscaping, driveways, sidewalks, pools, other structures like that. Then you have 5-year property, which is tangible personal property, and that's going to be your appliances, your cabinetry, other fixtures to the property that are not permanently attached. All right, and they're going to break all those things down. And generally speaking, they're going to be able to break down anywhere between 20 and 30% of the building's value into these properties' class lives. And thanks to bonus depreciation, which has been in place thanks to the Tax Cuts and Jobs Act, you can depreciate the 5 and 15-year property all in the first year. And that's going to allow you to significantly increase your depreciation expense, generating this pretty large loss in most cases, at least in my experience. And that loss is going to be able to offset your other forms of income as a real estate professional. So that's a cost segregation study in a nutshell.
Awesome. So we talked about real estate professional status, how that moves your rental losses into that non-passive bucket. You do a cost segregation study, you get bonus depreciation. What are we typically looking like, kind of bonus depreciation wise, on my purchase price? Well, what's a good rule of thumb that I can apply? And I'm not going to hold you to it. Nobody here is going to hold us to it. But like, if I'm buying a $1 million property, what can I expect bonus depreciation wise?
So bonus depreciation wise, it's all going to depend on the land value of the property. But as a general rule of thumb, and this is not how you should report on your tax return, okay? So don't take this as reportable tax return advice. As a rule of thumb, you take that $1 million property and you just multiply it by 0.8, all right? That's going to give you $800,000. And you can apply a 20% number to it. So that's going to be multiplying that 800,000 by 20. You're going to get $160,000, right? Then if you take that same $800,000, right, and you multiply it by 0.3, you're going to get $240,000. Your bonus depreciation is going to be somewhere within that range.
Okay, cool. So somewhere between 20 to 30% of the purchase price.
That's a typical good rule of thumb. If you want an actual estimate, a cost segregation company can give you a preliminary estimate of what they expect that property to actually generate in terms of depreciation if they were to do a cost seg study.
So to wipe my income out, I've got $300K of total income. I need to buy $1 million property, and the bonus depreciation needs to be $300K, and hopefully that creates a tax loss around $300K. I'm a real estate professional. I do the 750 hours, more time in real estate than anywhere else, or my wife does. We materially participate in the rental activities. So this $300,000 tax loss that we create by buying a $1 million property, cost segging it, getting $300K of bonus depreciation, this $300K tax loss is now non-passive. It can offset my $300K W-2 income, and I don't pay tax. Right?
Right, today.
Isn't that immoral?
No, it's not immoral. It's called
Why is
reading
it
the tax.
immoral?
Look. It's
Everybody
all
should pay taxes.
Look, it's all a matter of perspective, and I don't want to go down that rabbit hole. But it's not immoral. Look, at the end of the day, the tax code is public knowledge, all right? And if you want to go and read the tax code, or you want to hire a CPA to read the tax code on your behalf, which I'd recommend you do, and I'm not just saying that because I'm a CPA, but in this world, you got to outsource. You got to outsource when you're not able to do it yourself, or you don't want to do it yourself. Your time's better spent on other places. So anyway, it's not immoral. It's what the tax code allows you to do, and it's because the government wants you to provide housing for the general public, and that's the reason why landlords are offered these types of tax incentives to be able to buy these properties and to be able to ensure that they're profitable in the endeavor. So it's
Don't
about
blame the
incentives.
player, blame the game, right?
Yep.
All right, we got a question. How does Cossack help if one does not qualify for real estate professional status? YouTube, Karthik, thank you, sir. Appreciate you watching.
Yeah. So yeah, I can take that one if you want. So at the end of the day, we're still looking at maximizing depreciation here, right? So if you're looking at just like a typical rental situation, you've got year one of your rental, and maybe it's going to let's say that it's going to produce $5,000 of excess cash flow after paying for all of your repairs and maintenance and your mortgage payments and your property taxes and interest and all those other expenses. That would essentially be getting down to your free cash flow from the rental activity. But since depreciation is a non-cash expense, it's on paper only essentially. So when you have bonus depreciation rather than just straight line depreciation, if you have straight line depreciation, it's going to be very small. Like on a 27.5-year property, it's 3.636% if you own the property for the entire year, assuming you bought it on January 1st. So it's going to be relatively small. Now compare that to the figure that we were just discussing. That's between 20 and 30% of the purchase price, and compare that to like your rental situation. Maybe that property was a $200,000 property. Well, if you were looking at just straight line depreciation, then you're looking at only $7,500 of depreciation, and if you're making upwards of $10,000 in free cash flow, it wipes out a substantial portion of that, but not all of it. Whereas if you were to take do a cost segregation study and take bonus depreciation, it's going to be well in excess of that $10,000 of free cash flow in that scenario. So even on the lower side, say it's 25% of that $200,000 purchase price, you'd have about $50,000 bonus depreciation. It would wipe out all of the taxable income that you otherwise would have had on that property. And in addition to that, because it's in excess of, if you're not meeting real estate professional status, you would now have $40,000 of passive loss carry forwards that, because they don't disappear. It's if you don't use it, it does get carried forward into future years. So then again, assuming if everything just kind of repeated in the same fashion in the second year, and you had another $10,000 of free cash flow, but you've got $40,000 of passive losses that are just sitting there waiting to absorb it, you'd essentially be looking at, again, year 2, year 3, year 4, some number of years in the future where you would have multiple years of free cash flow being generated without having to pay any additional taxes on it. And then from there, your tax savings on those each year, that might make the difference between whether you can buy 2 properties next year instead of just 1 property, so you can expand your portfolio faster, even if you don't have real estate professional status.
Yeah, so that was a really good answer, Karthik. So, Karthik, what Justin was just explaining was, if you do a cost segregation study, you can accelerate the path. You can get all these passive losses up front, even though you're not a real estate professional. You can't claim them, so they just become suspended, but they carry forward. So he was kind of explaining that in future years, if you have passive income from your rentals, then those suspended passive losses previously will absorb the passive income, right? So you can kind of set yourself up to not pay tax on your entire portfolio for a while. But I would add to that 2 things. One, if you invest in businesses, I'm a big fan of investing in businesses, not necessarily real estate, in businesses. And I always use my hair salon as an example. You put $100,000 into a hair salon, it nets $10,000 a year for you. You're not materially participating. So that net $10,000 a year is passive for you. And that passive income can be offset by your rental passive losses because it all nets out on Form 8582. So you could cost seg your rentals. And you're getting feedback over here from Tom.
My bad.
Are you using your sexy mic, your this mic?
All right. Here, let me change it up.
You're like using your like iPhone.
I'm using the Yeti mic. I'm sorry, the Yeti.
Oh, the Yeti mic. Not... Oh man, I gave my Yeti away to Blake.
Really? Yeah.
Man. Yeah. Donation. Anyway,
Better now?
So what?
Does it sound better now? Can you hear me
Oh
now?
man, that's way better. See how much better that is, people?
Yeah,
I'm
you
telling
get
you,
a better
this mic.
boomstick, man, for this.
Oh yeah. If you're gonna do any sort of podcasting or videos, you got to get a Shure SM7B. They like
This is
deepen your
legitimately a
voice.
studio
Real nice.
microphone. You
Yeah,
can record an album.
It sounds like it.
Say come in a real deep voice. Coming up next, we've got some Barry Manilow coming at you.
Yeah. Actually, I would appreciate a song, Tom, about material participation. Go. Come on.
My creative side is not.
So you get your suspended passive losses, but they can offset any passive income that you generate from your rentals or any other business that you're passively involved with. So it doesn't just have to be rentals. But the second thing that I want to add is that it also gives you flexibility, right? Because like maybe I've got, I don't know, $100,000 of suspended passive losses that are going to carry forward into 2022. But in 2022, I decided that I want to liquidate one of my rentals. And now I can look at this 100K of suspended passive losses. I can liquidate into that essentially. Or I can 1031 exchange and I can keep the 100K of suspended passive losses on my books. But the beautiful thing about those suspended passive losses, like if my gain from this rental that I might liquidate is like $120,000, I could just sell it outright. And I'm going to offset that 120K gain with my 100K of suspended passive losses. My net's going to be $20,000 of gain. I'm going to pay $3,500 in taxes. And we're done with it. Right? It's super easy. And, I'm not a fan of paying taxes, but I am a fan of making it easy on yourself. And a 1031 exchange is always stressful. So those suspended passive losses can give you flexibility later on down the line. So I wouldn't necessarily shun the Cossack. Like I'm not a real estate professional. My wife's not a real estate professional, but we bought a 10 property portfolio. So it's 10 duplexes, $1.5 million. We're partnered with my parents, and we're going to cost seg that. One of my parents is a real estate professional, so they'll benefit. But
nice.
Yeah, you're getting feedback. See, somebody's commenting now.
I'm not getting feedback because I have everything.
No, I think it's coming through you.
It's not. It can't be because my audio is. It's only coming through. The only sound I have is coming through this right here. This is the head. So there's nothing coming into this besides like all the audio you're speaking is coming through my headphones.
Oh, it doesn't light up. It must be coming through Justin. If you can just mute your mic, Justin, while you're not talking, that'd be great. Thanks. So we bought this $1.5 million 10 property portfolio, 10 duplexes with my parents. One of my parents is a real estate professional. I'm not. My wife's not. So we're going to cost seg it, and we're going to get $300,000 or so in depreciation, bonus depreciation. And then that's split in half. So maybe $100,000 to $150,000 tax loss for me and my wife, and then my parents each separately. They'll be able to claim their $100,000 to $150K tax loss. I'm not going to be able to claim ours, but I'm still good doing it because I have another property that has like a $200,000 gain from just the appreciation since I've held it. And so when I cost seg this new acquisition, it gives me the flexibility to just liquidate this other property if I choose. I might not choose to, but it gives me that flexibility to just liquidate and not have to worry about a 1031 exchange, not have to worry about buying at the top of market or trying to replace that property within the 45-day identification and the 180-day replacement windows. Those are pretty tight windows to replace property. So it's not a bad thing, Karthik, to not qualify as a real estate professional, but also do a cost seg. So.
And look, I'll say this. Can you hear me? Okay, I'm not muted, right? Okay.
Yeah.
I'll say this, Karthik. Look,
here's
the deal. This is real world, right? So I invested in a bunch of syndicates, and I have capital gains coming from those syndicates. What I could do is invest into another syndicate or buy another rental property and run a cost segregation study on that rental property to offset the capital gains from those syndicates. So cost segs could still be beneficial to you, even if you're not a real estate professional. And that's facts. Like that's facts. So just letting you know, it's real talk.
Crypto. It's an interesting space. We might get into that next year.
We might. Crypto might have to. I mean, that's where the money's going. The money is
Yeah.
literally going into crypto.
Yeah,
Seriously.
the crypto CPA. All right. Well, that's all we have time for. So thank you all for attending, and hope you found a little bit of amusement out of this. We'll continue working on the amusement. I've started to realize, like, the team that puts on Saturday Night Live, that's a full-time job, man. That's like, think about all the jokes and everything, like how the structure goes and the flow.
Yeah,
That's a full-time job.
you ever hear about Seinfeld? How long it takes for Seinfeld to come up with a joke? It
Uh,
takes a long time for him to come
uh.
up with one joke. I don't know the exact amount of time, but he tells you, he's like, for me to come up with one joke, it takes a very, I don't know, it just takes a long time to come up with a joke. So to do a production like that, I mean, they don't just wing it. I mean, they're coming up, they're putting a lot of work into getting those jokes ready.
Well, if we have any
I don't know,
comedians,
man. I mean, the Matt Stone and Trey Parker, they make those episodes like in a week, real time.
Yeah, they got teams now.
Yeah.
well, if we
That's
have
great.
any comedians in the audience that would like to volunteer your time, we'll give you some cool T-shirts and swag and stuff. But if you would like to volunteer your time and help us make this a comedy, taxes, and bourbon, I'm thinking like Drunk History. You know that History Channel show? That's a pretty funny show. Let me know, and we can certainly work on some projects together. But anyway, thank you all for attending. We really appreciate it. We will see you next week at 7:30 p.m. Eastern on Tuesday.
See you then.